class, right? So it's part I need to mention. Okay, so this example we talk about in class. Let me just okay. So if you look at this, for example, you look at this income tax expense, right? Income tax expense was 9 here. Okay, so we know we need to debit 9, right, to the income tax expenses. And then we go to the balance sheets, look at income tax payable, right? It's item number 10, right? So it's the beginning was 8. Now right now 6 is liability decreased by 2. That's why we debit, right? We debit income tax payable for 2, and then again we debit income tax expenses for 9, and then we credit cash, right? We credit cash for 11, right? So that's the summary journal. Okay, this is item number 10, right? So these are all item number 10, the summary journal. But in reality, most of the time we have the deferred tax assets, right? Remember deferred tax assets, deferred tax liability, right? We talked about that in the previous chapter. So most of the time we have those deferred tax asset or deferred tax the liability, or we may have a both, right? So then when you write this summary journal, you want to include that item, the changes, right, in the deferred tax assets or deferred tax liability. Okay. So we do have homework questions, have that situation. Okay, but this example we don't have it. Okay. So again, make sure you practice homework questions. You're gonna see a little bit more issues we haven't discussed in class. Okay, so but just keep in mind when you write a summary journal, you want to include those related accounts. Okay, the changes or account itself to that into that summary journal. Okay, and to figure out the cash inflow or cash outflow. Okay. So this is the spreadsheet method. Again, the spreadsheet method, we already know we have three activities, right? We have operating, investing, and financing. Okay, so then if we use the spreadsheets, for the operating, we only use the direct method. Okay, so that's the direct method we're using. Okay. So now we're gonna talk about the indirect method. Okay, so this is what we talked about so far. So now let's talk about the indirect method. Okay, but just keep in mind, direct method, indirect method is only for operating activities. Okay, just for operating activities. The investing activity, financing activity, they are just like if you call that, you can call that direct method. Okay, you just need to figure out those items. Okay, so listed those cash inflow and cash outflow, and the investing and financing activities. Okay, you list it directly. Okay, so you can call that direct method. Okay, so so then we talk about direct method. We only talk about the operating. Okay, so let's talk about the indirect method. Okay, so indirect method, again, this is just for the operating activity only, right? So investing, financing will be exactly the same, right? With the the so far we talk about. So for the indirect method for operating activities, as we talk about the cash, you remember what is the operating activities, right? Those are the cash flow either related to our revenues or expenses. Okay, so those cash inflow will be related to our revenues, right, under the operating activities. Those cash outflow will be related to our expenses. Okay, that's why net cash flow from operating activities will be related to our net income, revenue minus expenses. Okay, so these are related. Since we want to figure out what is net cash flow from operating activities, because that net cash flow is related to our net income, then we can start with net income and then plus minus those adjustments. Like the example here, we're going to start with this net income, And then we have those adjustments. Okay, so you can see we have a bunch of adjustment, plus, minus. Okay, and then by the end, gonna be net cash flow. Okay, so this is so-called the indirect measure. We try to figure out net cash flow from operating activity indirectly. Okay, indirectly. Okay, so starting with net income. Okay, so let's look at those adjustments. Okay, so those are the adjustment. So we have three type of adjustment. Okay, three type of adjustment. So first type of adjustment, we can call that non-cash operating expenses. Non-cash operating expenses. So the example is depreciation expenses, amortization expenses. Okay, so those are the so-called non-cash operating expenses. These are the expenses, right? When you figure out when you report income statement, those are the expenses, depreciation expenses, amortization expenses. You need to subtract, right? Those one, right? Depreciation related to our equipment, right? Uh, Buildings, etc. And amortization expenses related to our intangible assets, right? So we're going to subtract those ones. Those are our expense. We subtract it to get net income. Okay, but just remember, we didn't pay for those expenses. There's no cash flow for those expenses. Okay, how do we get this depreciation expenses? Remember, by the end of the year, we need to make adjusting journal, right? We debit depreciation expenses, we credit accumulated depreciation. You can see we don't have a cash, right? We don't credit cash. Okay, so this is non-cash operating expenses. Okay, so we subtracted to get net income, but we didn't pay with cash. Our cash no change. Okay, on our cash accounts. So you think about the cash flow, because we subtracted to get net income. Then now, if you want to start with net income, you need to add it back, right, to get the cash flow. Okay, so that's our first type of adjustment. Okay, so we call that non-operating expenses. So example, the depreciation expenses and amortization expenses. Okay, that's the first type of adjustment. This is the first type of adjustment. Okay. Second type of adjustment are those gain or losses. Okay, this is the second type of adjustment, gain or losses on sales. Okay, so we sold our equipment or sold our land. Okay, so we had a gain, we had a loss. Gain or loss, gain was added, right, to in the income statement was added to gain was a kind of revenues, right? Loss was kind of expenses. Okay, gain was added, loss was subtract to get net income. Okay, but we don't, those gain and losses are not associated with additional cash receipts or cash payments. Okay, so let me give you example. For example, we have a land. Okay, so we have a let's say we have a land. Okay, we spend $10 million, okay, to purchase the land. Okay, so our original cost was $10 million, right? So we have this T account of land, and then we sold the land for, let's say, for 8 millions. Okay, we sold the land for 8 millions. So what's the journal? You're gonna debit the cash for 8 millions, right? We're gonna credit land because we sold that. We're gonna credit land for 10, and then we recognize the loss, right? 2 millions, the difference. Everyone's okay with that, right? So that's the loss we talk about. Okay, loss on sales of those long-term assets. So see, this loss will be added. I mean, no, will be subtracted in the income statement, right? So loss is one of the expenses. Okay, so when we calculate net income, you need to subtract the loss. Okay, but remember, we didn't make additional payment for the loss. Not like a regular expense, right? Like, for example, salary expenses. Okay, we need to pay cash, right? We need to make payments to the employee, right? So relate to the salary expenses. But this expense, this loss, is special expense. Okay, so this loss on sales of land we didn't make payments, okay, for the loss. Instead, actually, we received payments, right? We received cash. You see, we didn't make cash payment. Instead, we received cash, 8 million. But this cash receipts, 8 million, will be reported in the investing activities. Is that right? That's the investing activity. Okay, you call that internal investing. Okay, which is cash inflow. Okay, you're going to report it in the investing activity, not operating. Okay, so for the operating, remember this is the indirect method. We start with net income, then you need to make adjustment, right, to figure out what is cash flow from operating activities. So in this case, because loss was subtracted, right, to get net income, but we didn't pay for the loss. Okay, so our cash didn't change basically, right? So I mean, we're talking about operating, okay, cash operating activities. So that's why we want to add it back. Okay, to get the cash, we want to add it back to the net income. Okay, and similarly, so we need to add. Okay, so here, okay, so this one we need to add, right? Definitely. So the loss we need to add, and similarly the gain we need to subtract. And gain similar to the loss. Okay, gain we didn't receive additional cash for the gain. Okay, so let's say if you got the cash 12, right? If you got the cash 12 millions, you sold for 12 millions. Guess what? You're gonna recognize the gain, right? For two, right? $2 million here. But we don't receive additional cash for 2 million. Okay, remember the whole 12 millions will be reported under the investing activities. Okay, so for the operating, nothing, no, there's no cash flow for operating, okay, for this transaction. Okay, so we didn't receive additional cash payments for operating. Okay, so that's why, but the gain was added to get net income, right? So that's why we want to subtract from the net income, okay, to get the cash flow from operating. Okay, so that was the second type of adjustment. Again, the first type of adjustment, those non-cash operating expenses. Okay, second one are those gain or losses. Okay, loss should be added back, gain we need to subtract. Okay, so that's the first two type of adjustment. If you look at this example, I mean those the long, the big example. Okay, so remember we have this income statement, right, like this. Okay, and then let's look at the indirect method. Okay, let's just look at the operating. Okay, operating activity only. So again, those operating activity relate to the revenue or expenses. So that's why you kind of relate to those income statement item, right? So so we want to figure out what the net cash flow. So we're going to start with, this is the indirect method, right? We're going to start with net income, okay? And then we're going to plus minus those adjustments. So we already talked about those two type of adjustment, right? So first one is non-cash operating expenses. In this case, we have this, right? Depreciation expenses is a non-cash operating expenses, right? So we need to add it back. And we have a loss on sales of equipment, right? So we need to add it back, okay? And we have a gain here, we need to subtract, okay? So we need to make that adjustment, okay? Subtract, you add those two, okay? So that was the first two type of adjustment. And then how about direct method related to those items? If you're using direct method, how to deal with those? Do we have a cash flow on these items? Not really, right? Because those are non-cash item. Okay, so if we're using direct method, we don't have a cash flow. Okay, operating operating activities. That makes sense, everyone, right? Okay, so that was the first two type of adjustment. Okay, first two type of adjustment. And the third type of, this is the third type of adjustment. You want to go to the current asset, current liabilities. Okay, look at those changes. Okay, and then you may want to plus or minus. Okay, for example, you can see here, this is the summary. For example, if for the current assets, okay, if the current assets increase. You know how to deal with how to figure out current asset increase or decrease. So you need to go to the balance sheet, right? Go to the balance sheet. You see the beginning balance, right? You see the end balance, right? You know how it's increase or decrease. Okay. So let's say the current assets increase, we need to subtract. Okay. So we talk about adjustment, right? So you need to subtract. Okay. Those changes from net income. And how about if current assets decrease, you need to add it to the net income. Okay. So again, this is the indirect method, right? This is the third type of adjustment. The example, let me give you an example. For example, accounts receivable. Okay. So accounts receivable is one of the current assets, right? Let's say accounts receivable increase. If accounts receivable increase, that tells us relatively we receive less cash payments, right? We have less cash flow, basically, compared with accrual-based accounting. Okay, so accrual-based accounting, basically you got net income, right? So now how to figure out the cash flow? So you need to subtract. Okay, and similarly, accounts receivable is decrease. If accounts receivable decreasing, okay, so accounts receivable decrease, that means tells us relatively we receive more payments relatively, right, compared with accrual-based accounting. Okay, so that's why you want to add it. Okay, you want to add the changes. Okay, add the changes to the net income. Okay, so that's what's the current assets. How about the current liability? Current liability is just opposite. Okay, so if it increase, you add to net income. If decrease, you subtract. Okay, so let's say accounts payable. Right, let's say accounts payable. Accounts payable increase. Accounts payable increase, that tells us what relatively we made less payments, right? That's why we owe more. Okay, so relatively we made less payment compared with accrual-based accounting. Okay, so when we made less payment, that's why we keep more cash with us, right? So cash should be higher. That's why you need to add. Okay, and similarly, if it decrease, you need to subtract. Okay, so this is the third type of adjustment. Okay, third type of adjustment. So we only have three type of adjustment. Okay, it's the third type of adjustment. So then go back to this example. For the third type of adjustment, remember those are things, right? So we have, this is indirect method, right? So you go to the balance sheet, you see the accounts receivable increase. Accounts receivable, yeah, increase for 2, right? Increase for 2. So accounts receivable increase. Remember that rules, right? Go back to this, right? So remember, accounts receivable, current asset increase, you need to subtract, right? So so we subtract. Okay, we subtract accounts receivable. Okay, from the net income. Okay, and then so then we have these the cost goods sold related. Those the balance sheet item. One is inventory, one is accounts payable, right? So those are the current asset and the current liability. And inventory decrease. Okay, so inventory decrease, you need to plus, right? Remember, based on the rules. Okay, and accounts payable increase, we need to plus. Okay, so those are the adjustment. Okay, so and then related to salary expenses, we have salary payable. So you go to the balance sheet, you see the changes, right? So in this case, salary payable increase for 2. Okay, so so the current liability increase, you need to plus. Okay, and then how about the interest expense? This is interest expense comes from the bonds, right? So the bonds interest. Okay, so when you pay bonds, right? Bond holders periodically every 6 months pay them interest. Okay, and then we have accounts. We call the bonds discount, right? Discount on bonds payable. So discount on bonds payable is what? Is a contra. Excuse me. Discount on bonds payable is a contra liability accounts, right? It's a contra liability account. That's why it's going to be opposite. Okay, so in this case we have decrease, right? So bond discounts decrease by 2. Okay, decrease by 2. So it's a contra account. That's why you follow what you follow increase, right? So it's just the opposite, okay? So it's decreased by 2, normal current normal liability. If it decrease, you need to subtract, right? But this is the control account, that's why you add, okay? So you add 2, okay, to that. Oh, sorry, not this one. You add 2 here, okay, to the bond, to the net income. Okay, and then we have insurance expense. So one items, those current assets. Okay, so prepaid insurance relate to that, right? So prepaid insurance in this case is decrease. Okay, uh, decrease current assets, decrease, you're gonna plus. Okay, so that's why we plus 3. Okay, and then the last item here, income tax expenses. One of the items is related to income tax expenses, income tax payable, right? Which is current liabilities. So in this case, current liability decrease for 2, right? If it decrease, then we need to subtract. Okay, so those are the third type of adjustment. Third type of adjustment. And then if you look at the third type of adjustment, and then you just look, and then you look at the direct measure. Okay, you can see these are related. Those are really related. See this sales revenue is 100, and then increase in accounts receivable here, we need to subtract, right? So we to figure out the cash flow for the indirect measure. How about direct measure? Direct measure, remember, cash from our customers is 98. What do you see? You see, this is a summary journal, right? Do you see that? This is a summary journal. Okay. So what do? We debit cash for 98, right? And increase in the in asset, we also debit, right? Debit 2 to the accounts receivable, and then we credit sales revenue for 100. Is that right? So that's the summary journal, okay, basically. Similarly, remaining things, it's just summary journal, okay. So what do you see here? You see this indirect method is between the accrual-based accounting, which is income statement here, right? This is the accrual-based accounting, and the direct method, right? Direct method, which is the cash-based accounting. Okay, so accrual-based accounting and the direct method is the cash-based accounting. So the indirect method is just try to explain the difference between the accrued type of accounting and cash-based accounting. That makes sense, everyone? Okay, so this is the indirect, and then if we add all 3 type of adjustment together, so that will be like this, right? So again, this is the income statement, this is accrual-based accounting, and the direct method here is the cash-based accounting, right? So then the indirect method here is just between, okay? So we'll try to explain the differences between these 2, okay? And so now we include all of those 3 type of adjustment. Okay, so those are the adjustments. You can see these are adjustments. We have all 3 type of adjustment here included. Okay, and then 12 plus minus, and then by the end is 22. And remember, direct method, what do we got? 22, right? So because these should be the same. Okay, these are the net cash flow from operating activities. Any question at this moment?
No.
Yeah, you good? Okay, that's great. Okay, so if not, let's